Well, volatility hit a 50-year high in 2011, leaving the S&P with the smallest price change in over 4 decades. Basically, looks like we might be headed for a flat year. Now, joining us now to talk more about volatility in the markets is Hugh Johnson, the chairman and chief investment officer of Hugh Johnson Advisors, here in New York with us. Great to see you, Hugh.
Nice to be here.
And, you know, we've been saying this all year long. The market's been great for traders, terrible for long-term investors, and that volatility is just an example of that, right?
Yeah, and I think if there's anything, when we look back at 2011, if there's anything that jumps out at you is the number of, we call them exogenous events, but surprises, basically unexpected events. When you start with Japan, the Middle East, and the rise in oil prices, you move on to Washington, which was full of surprises all year long. Needless to say, the failure to raise the debt ceiling and that whole problem. And then, of course, Europe. Europe probably had more surprises almost every day, every week.
Right.
And as a result, the markets reacted to all of those unexpected events, and we had enormous volatility. And it made, just as you say, it was very tough on investors. Good for traders, not good for investors.
No, not good for investors, though. You say that in a third year in a bull market, you're usually up about 6% on average, and we're not going to make that.
Well, now, we're not going to make that, but don't forget, the third year doesn't end until the end of February. So it could be the case that in January and February we make enough. And I don't think we'll be right on the nose. You're never right on the nose, but maybe we'll have a good January and a good February, so we'll close some of that gap. You're right, the third year of a bull market is not as good as the second year, and certainly not as good as the first, which is, of course, the barn burner.
Well, what could lead to a possible rally in the first few months?
I think one thing that's going to possibly lead to it, Betty, is frankly, we've had some pretty good markets more recently, and I think confidence in our markets is starting to get a little bit better. But the most important thing is that has to go hand in hand with better economic numbers. We've gotten some good economic numbers. So if you see December employment show, say, 160 to 180,000 additions to jobs, which is a real good chance, based on some of the numbers we've seen.
Based on what we've had in the past.
Well, the claims numbers have been, we've seen very sharp declines, unexpected declines. The Philadelphia Fed report was pretty good. So I think 160 to 180,000. So if you saw December numbers in January be good, January numbers at the beginning of February, employment numbers be good, and then the rest of the panoply of economic numbers come in a little bit better than expected, then you'd have a good market. So I think there's a real good chance of a good January and a good February.
And then we hope nothing blows up in Europe in the meantime to spoil the party. But Hugh, you know, we had a guest earlier on, Eric Van Nordstrom from Credit Suisse, who was saying, look, he thinks that the Fed is going to come out with some sort of QE3, maybe even in the first quarter of next year. Is there any pricing in of that at all?
No, I don't think there's pricing in. I think, quite frankly, that might be one person or a group of people's expectation. It's not mine. I don't think it's the consensus. The consensus is that we're not going to get QE3. We've probably gotten all we were going to get from the Fed. No, we're not going to get it at all. I think that the Fed's got to be very happy with what's happened. First of all, they put, not recently, but they put some downward pressure on the dollar. That has led to an improvement in exports. The only thing that's really missing on it also has, I might say, led to a recovery in inflation, although inflation's coming down some. But the point being is that I think the Fed has been enormously successful. They see economic numbers now that are getting a little bit better. And I think they have to be pretty happy with what's happened. And even if they don't have a QE3, look at short-term interest rates and long-term interest rates are still pretty benign. And if they took the lid off, our long-term rate's going to go up. Well, maybe a little bit, but not a lot. Not enough to really threaten this very feeble recovery.
So Hugh, just to wrap it up then, for next year, what's going to outperform in your view?
Well, I think, you know, next year is going to be like the fourth year of most bull markets. It's going to be, first of all, a positive year, I hope. I cross my fingers when I say that. It's an election year. Those are generally positive. It's the fourth year of a bull market, on balance positive, but not as good as the long-term average. Yeah, long-term average 6.8%. It'll be less than that. And you're going to see things like consumer cyclicals and consumer non-cyclicals do well. Strange bedfellows in the last year of in the fourth year, I shouldn't say the last year of a bull market. And you might also see industrials do well and healthcare do well. So you've got to be sort of placing your bets in both sides of the bull camp and the bear camp.
Okay, cross your fingers. All right, Hugh, great to see you. Thank you. Hugh Johnson of Hugh Johnson Advisors.